great pleasure to welcome this panel here today, and I'm going to ask Jonathan Kramer to make the introductions of the group as we explore what is and isn't happening in the auction universe.
Good morning. I'm John Kramer from Baker Hostetler here in New York, and I'm pleased to introduce our panel. To my left is Adam Fitzner. Adam is a principal at Corinthian Capital. Corinthian is a private equity sponsor based here in New York. He was previously a managing director in Evercore's restructuring group and a director at Miller Buckfire. He has significant experience working with companies in the food and consumer product, direct marketing, equipment rental, and building material segments, along with a number of other industries. Corinthian is headquartered in New York, but also has offices in Chicago and Boston, and it focuses on investing in businesses with sales between $50 million and $250 million. It was founded in 2005. Mark Boydman is a managing director at Peter J. Solomon Company, where he's a member of the Media, Entertainment, Communications, and Technology Group. Mark's been recognized by digital media executives and professional publications as a leading investment banker in the media sector. His clients have included Clear Channel Outdoor, Cox Enterprises, DirecTV, Discovery Communications, and Disney, along with a long list of other major players. Before joining P.J. Solomon, Mark was head of Barclays' out-of-home media, TV broadcasting, and radio coverage. Mark started his career as an attorney in the M&A group at Paul Weiss. I'm sure most of you know that P.J. Solomon is a privately held investment banking advisory firm based here in New York. Jeremy Swan is a principal in Cohn Resnick's private equity and venture capital industry group, where he is a practice leader and M&A consulting services leader. Specializes in strategic transaction advisory, M&A advisory, financing advisory, transaction readiness, and post-transaction readiness strategy and integration advisory to Cohn Resnick's clients. Cohn Resnick is an advisory firm. They have 2,500 employees nationwide, provide a wide range of accounting and assurance, tax and advisory services in a broad range of industries. John Alata is my partner. He's in Baker Hostetler's Cleveland office, where he specializes in M&A involving public and private companies, with a particular focus on private equity. His experience extends to a very broad range of industries and to representations of buyers and sellers. So now that you know everybody, let's see if we can get some stories out of them. How has the M&A auction process changed in recent years? Mark, why don't you lead off with that one?
Sure. Good morning. I was just saying to Jonathan earlier that the last couple of years have been really strong for sell-side M&A. Processes we've run, just seeing the difference in being able to tell buyers who are bidding in a process that they need to deliver, marked contracts, fully committed financing, that they have to have done buy-side QOV, things that they normally wouldn't do. They wouldn't spend money in processes, particularly private equity firms. Big change in the last couple of years. If you have strong assets and you're selling strong assets, you can make all sorts of requests, and to our pleasant surprise, in many cases, they all comply, both on the strategic side, certainly, as well as on the private equity side. So I think that's been a real change in the last couple of years, just certainly having that power as a sell-side advisor.
And how have buyers responded to that? Have they complied with these requests? Have they pushed back?
Generally they do. Sometimes we're surprised, but generally they do. Private equity firms especially, in the last year and a half or so, they do. I mean, they don't always fully comply, so they'll start the buy-side QOV, they'll hire someone, they'll spend a little money, they won't complete it, but they'll do a lot of work, more work than we've seen, call it 4 or 5 years ago. So things have definitely changed, and again, it really depends on the quality of the asset you're selling. If it's an asset that is in demand, you will see private equity and strategics do a lot of work, and I'm talking about early on, before actually knowing it's their asset, and that's definitely a change in the last couple of years.
Adam, what have you seen?
I'd say the same thing, echo the sentiment, but I would say, at least in the last 2 or 3 years, the sellers have been doing a lot more work to try to prep their assets for sale. So a lot of the things that Mark was talking about that people have been trying to push onto the buyers, a lot of the sellers have been doing proactively. So sell-side quality of earnings work, market studies, staple on financing, or at least getting a market read from a couple different lenders, really trying to spoon feed the buyers that they're talking with about trying to sell to.
John?
I think we've seen similar things, especially with the shortened time frame. And I think the one thing that we've seen go along with that is much shorter exclusivity periods after the bids are submitted, to sometimes even no exclusivity periods, where you're able to really push buyers to get the deal signed in a week or two after they submit their final bid, or shorter, and not give out exclusivity or give very short periods of exclusivity out.
How do you guys view a PE buyer's approach to be different from a strategic's? Want to start with that, Adam?
Sure. I think the big difference is really speed and certainty at the end of the day. There's a lot of other differentiating factors, and it really depends on who the buyer is. But I know we went through a process, I guess 2 years ago, selling one of our assets. Had a lot of interest from both strategics as well as from private equity funds. And in a lot of cases, I think most people assume that strategics can pay up, and they can, to end up winning an auction if they want to. But we were fundraising at that point in time, and we had a sponsor that stepped up at a price that was pretty comparable to where the strategics were, and they said, we know we can close in 2.5 months, and there was a lot of certainty. We had done a lot of diligence on them, and knew that they were people that honored their word, and at the end of the day, that was pretty important to us, trying to get some points on the board for our fundraising process. So they ended up winning the process, and actually were a real pleasure to deal with post-closing as well.
Mark, what have you seen?
Yeah, look, I think as a sell-side advisor, getting bids from strategics who have significant cash on hand is always more comforting than having a private equity firm who says that they will, whether they're bringing in X or Y as their financing source. I just think it's easier. There's less diligence. We don't have to worry about a financing source's diligence, even if it's a slam dunk. It's just an extra thing that we need to think about. So I think certainly we welcome strategic buyers who have cash on hand. But if it's a strategic buyer who's also going to need financing, then it sort of levels the playing field with a private equity firm. But we've seen deals, frankly, when private equity firms, particularly for the lower middle market to middle market assets, where a private equity firm might say, look, given the equity check here and given the financing need, we're just going to do it all from our fund, and we'll figure out the debt piece post-deal. Now that is something we've seen pretty rarely, but that happens, and that's a great place to be in as well. It's almost as comforting as when a strategic who's got a nice cash balance sheet comes in and says, we've got the financing taken care of. We won't need a third-party financing source.
Have you seen situations where strategics, because of their elongated approval processes, might be a less attractive buyer because a private equity fund might be able to be a little more nimble?
Yeah, I mean, look, I think private equity firms tend to move quickly, at least the ones that we've spent time with recently. They recognize, to your point, they recognize that speed is helpful in a process, especially when there's strategics in the mix. But that's what's unusual, is oftentimes private equity firms in bidding processes, they always question what's their angle. And if they have no angle, they don't participate if there's a lot of strategics in a process. They just don't want to spend the time. But lately, I would call it the last year or two, we've seen private equity firms who are as aggressive as strategics in processes, whether they have an angle or not. I think that's very much reflective of the fact that there are not a lot of very high quality assets in the marketplace. And that's been a real shift in the last couple of years. Again, very high quality assets. I think you can run a very efficient process, and you'll have strategics and private equity firms at the table. But in processes that are less high quality, if it's not that diamond in the rough, well, you're going to have a much more difficult time both encouraging private equity firms to spend the time if they don't have an angle, if there are strategics, and frankly, even getting strategics excited about an asset.
Jeremy, what have you seen here?
Well, we spend a lot of our time, probably 50% with buyers, 50% with strategic buyers, 50% with financial sponsors. And over time, we've seen the financial sponsors become much more disciplined buyers in most cases than the strategics. And it's partially because this is what they do day in and day out. This is part of their process. They know what they need to see on the front end. They have their processes they need to go through. Some strategics, the larger strategics, are very good at it as well. But what we see in terms of moving from point A to point B, the private equity firms tend to have a better process in place and are more disciplined. I think the challenge has been, given today's market, with, as one private equity firm put it to me yesterday, every attractive asset that they're looking at is getting into an auction process and making it that much more difficult. There are a lot of strategics involved, and the ones that aren't in auction processes are, for the most part, ones that are probably not going to get a deal done. They're having a tough time because there's some hair on the deal. So the deals that are going through the auction process now are the higher quality ones. We're seeing a lot of strategics and a lot of financial sponsors on each deal, and it's getting to the point right now where, unless, going back to what Mark said, unless the private equity firm has an angle, in most cases they're not even getting involved in the auction process, because they know what they need to go through, they know what their max that they can pay for the deal is to basically hit their IRR. And with the way strategics are bidding right now, with the amount of cash they have sitting on the table, it's very difficult to get those deals done. I have one client that started off with 12 portfolio companies at the beginning of the year. They've sold off 6 of them, and also just raised $1.5 billion fund and have not been able to put $1 to work in that new fund. So it's definitely a bit of a challenging time, but I think we're seeing from an auction process perspective, both private equity firms and strategics being effective and successful, is that there are differences in the way they go through the process.
How does a seller's approach to private equity differ from its approach to a strategic? Does it tell a different story to a private equity shop than it does to a strategic? Mark, want to start?
Yeah, we often think about that early on in the process. We often pitch that we will tailor the process, and sometimes we do. We often pitch that we will tailor the process for strategics versus sponsors. What ends up happening, as many in the room know, you don't always end up doing that at the end once you have your marketing materials put together. But we do, in many cases, have specific materials that are geared up for strategics, identifying the opportunity for that particular strategic. We've done that. We did that actually about 6 months ago for a process, and it made a lot of sense because there was a strategic buyer that we were sure was going to be interested in the asset. So we wanted to really point out all the reasons for that strategic. But agree with what Jeremy said. I mean, the private equity firms we're getting so many inbound emails and calls from private equity firms who need deal sourcing. That's been a huge uptick in the last 6 to 12 months. We just get an email from a private equity firm we don't have a relationship with, who wants to make sure we're on their radar screen. They've seen some deals we've done. They wanted to make sure that they get calls from us in the next deal. And so that's been a real change. So I think private equity firms are really struggling, and I think again, I agree that they have a lot of cash in their funds that they haven't deployed and are trying to find deals for that. So I think we can, if we look, we have not done this, but I think we would, if we thought of a private equity firm who made sense for a particular asset, given what they've done in the past. I think we could maybe tailor materials, but just given how busy we are, we haven't done a lot of that, to be fair.
And just to add on to that, I'd say one of the things we are seeing people do a lot in most processes is they'll run a two-step process where they'll go out and they'll canvass the strategics first. And I think there's 2 benefits. One is the strategics typically take a lot longer to engage, and so you want to give them more lead time to really see if there's any interest. And second, I think the sellers will assess whether there's really interest there. If there is interest and you've got somebody who might be a real outlier, you might even give them exclusivity and lock up and move forward. You can get some kind of a protection. If not, then they'll use the financials as really the fallback to the process, because it's a lot more robust, a little bit more certainty that you'll be able to get there with somebody, just given the fact that there's so much capital overhang and people looking to do deals right now. So
I'm going to disagree. I think sometimes we do that. I think we're sensitive. The challenge with doing that is you go to a bunch of strategics and none of them bid, or they don't bid in the right area, and then you go out to sponsors. And everybody talks, as you know, and then sponsors find out that there's no strategics interested in the process, and you start to see financial sponsors who are these days paying strategic-like multiples come down and pay sponsor-like multiples. So I think in some cases that might make sense, but we would not always recommend just going out to strategics first and then leaving the sponsors as a second step. I think it's risky.
Do you guys do different things with management, depending on the PE or strategic?
Yeah, so it depends if it's a founder-owned company or not. Founder-owned companies, at least in the last few deals we've done this year, there's always, especially if you have private equity buyers, there's always this 20 to 30%, or in some cases 40% request for an equity role. Right. So I think that certainly comes into play. But if it's a strategic buyer, it may or may not, depending on whether they'll need founders or the management team.
Right.
Oftentimes there's also an equity role, but not every case.
Yeah.
Well, and I'd say there's a lot more tension with strategics as well, because
Sure.
a lot of strategics obviously,
Don't need the management.
they may or may not need management, and so trying to get management comfortable with who bidders are. In some cases, we've seen processes where they tried to go and talk with strategics, and the management team would flat out tell us, we're not talking with strategics. The banker's trying to get us to, but we won't. We're really focused on trying to find a sponsor. And
What can you do with management to get them to buy into your process, sort of whoever you sell to? Do you have other techniques that you can adopt to get them committed?
Find the right team when you make the initial investment. That is really a big piece of it, because it's building a relationship, helping them understand what the exit is, and really being aligned with them from the get-go on what you're planning on doing. And keeping to your word on that, I think, is pretty important. I think a lot of sponsors may bait and switch teams that they tell things to, but really being aligned in what you want to do, and also creating incentives. There's got to be monetary incentives in place for people if you're going to end up going down the strategic path, and you need to do that well in advance and make sure everybody knows what the plan is. Otherwise, a lot of people can get a little spooked, and unfortunately, then they're not focused on the business, and that's really the most important thing when you go through the process, is you want to make sure that the company's performing.
I think the most important thing from an advisor's perspective is really focusing in on, it's not working or not. Can you guys hear me? Without this? All right.
There you go.
Oh, there we go. There you go. So I think one of the most important things from an advisor's perspective in working with a client that's considering moving down the sale process is that education process that has to happen. The materials are extremely important, getting the financials right are extremely important, but really sitting down with the management team and helping them understand what the process is going to look like, what the potential buyers are going to look like. We work with a lot of owner-operator businesses. Thanks. And in a lot of these cases, just because there's so much information out there, they have one view. A private equity buyer is going to try and do this to my business, so I don't want to talk to private equity. I only want to go to strategic. Another will say, well, we're very competitive. We don't want our information getting out there. We don't want to even talk to the strategics. We only want to go the private equity route. And there's a happy medium for each of those. So I think one of the biggest roles that we play is really educating the management teams and being an advisor to them and helping them understand what the process is. Whoa! Stick with this one. I'll give them 15.
Somebody doesn't like what you're saying.
If you want to use this, actually.
We got frequency hits coming from I don't know where. We were all set up. It was beautiful. So I don't know what's that first.
Okay.
There you go. There you go. Okay.
We're just coming in and out.
I'll just keep going, and hopefully everyone can hear me. So no, when it comes down to really educating the management team and helping them understand the benefits of both private equity and strategic, and that's the role the bankers can play, that's a role that we can play, it's a role that the lawyers can play, but really spending time with them, helping them understand what the different options are out in the market, what a private equity firm is going to look for. Because there's so much data out there, so many stories, not all of them good, which will turn off some of the management teams from looking at different avenues. And I mean, part of the role that someone on the banking side can play is really kind of educating the company to understand that there are plenty of options out there and the rationale for going after private equity, going after a strategic, and really what they're going to be looking for. Because the criteria, unless it's a private equity firm that's looking at an add-on to an existing portfolio company, the criteria can be very different between a sponsor and a strategic. One is going to be very management team, financially driven. The other one's going to be more strategic driven. And how's the product fit? Is it at geography? What are the synergies going to be between the two businesses? So when you think about the criteria, I think it makes sense to market them differently to different potential buyers, but also have the management team understand what they're going to get at the end of the deal.
Yeah, it's also a staging thing. So oftentimes what we advise clients, when do you bring the management team in? So if it's a negotiated deal, do you need to bring the management team in? Let's see if there's a path to a transaction. We can bring the management team in later. Why spook them? Why distract them? Why create any tension? And oftentimes we don't get to a deal. And so there's no point involving them. So I think in an auction process, you certainly need to involve them. But if it's a negotiated deal, or if you're only planning to reach out to 3 or 4 buyers, maybe you have some of those early on conversations with principals first, meaning if it's a private equity owner, private equity deal team and investment bank, and leave the management team on the side.
What strategies can buyers adopt, short of overpaying, to maximize their chances of winning an auction? Adam, you want to start off on that one?
Sure. So I think flexibility and user friendliness, also doing what you say you're going to do, I think is incredibly important in building trust through the process. And what I mean by flexibility, there are a lot of requests that Mark was talking about, which sometimes as a buyer you feel like you're jumping through hoops a little bit. But it does mean a lot to the sellers, and listening very closely to what their real concerns are and what their hot buttons are, and understanding why, and making sure that you're addressing them. I think that's incredibly important. There was a process we just went through and closed on a new investment about a month ago, where rep and warranty insurance was something that was incredibly important to the sellers. And that's a new product that's emerged over the last couple of years. And really it's something that's just starting to work its way down into the middle market and lower middle market. And it was something that we don't do a lot of, but it was important to the sellers, and so we were flexible on it. So I think that's something that really helps you differentiate yourself. I think the other is, like I said, doing what you'll say you do. Because there's only 3,500 private equity firms in the country. It's really tough telling who's who, and understanding who's going to do what they say they're going to do as you go through the process, and being able to build trust, build rapport with people, let them know that there's a clear plan for how you approach things, what your process is. We were just talking about the management team and how scary a process this can be, and trying to let them understand what that process is going to look like with you, letting them understand what the 180-day plan is going to look like post-closing, what the next 2 or 3 years is going to look like, and what the eventual exit will look like with you. I think all that's really important because not only does it align everybody's incentives down the road, but it also just eliminates some of the fear that we were just talking about.
Yeah, I mean, following up on what Adam said, I mean, if you're not going to, short of price, the obvious thing to separate yourself is certainty of close, and being able to close as fast as possible, whether it's to eliminate a financing contingency or to have all your work done when you submit your bid so you can close quickly. And then rep and warranty insurance, we have a couple funds that we represent who come in with rep and warranty insurance and feel that it really sets them apart and enables them to win a process that they wouldn't have otherwise won based on their price, because they're able to really take a lot of the indemnity risk and the downside risk on post-closing off the table for the sellers.
How does that work?
So
in a nutshell?
In a nutshell, the buyer will go out, usually the buyer goes out and buys an insurance policy that they then use as most of their recourse, if not their sole recourse, for indemnification claims for breaches of reps and warranties post-closing.
How much does that cost?
It's usually somewhere, I mean, what we're seeing is usually somewhere between 3.5% to 5% of whatever the insurance amount you buy is. And then the amount of insurance you buy is usually tied to where you would typically put a cap in a deal. And so it's actually, I mean, a lot of people do it. We have strategic clients who do it as well. It's not only the financial buyers, but we see financial buyers use it a lot more than strategics.
Yeah. I mean, effectively, you're just outsourcing the deductible and the escrow to a third party, which it has its pros and cons. We typically don't like doing it exclusively, just because then the sellers don't really have any skin in the game, right. And they don't have as much motivation to work with you. And it gets a little more expensive, right? Yes. Yeah, but at the end of the day, it all gets baked into the purchase price, and so we've seen some sellers say, "Oh, we're not really all that interested in rep and warranty insurance because we feel like we've got a good partner, and we think we know how this process is going to turn out because our information is really clean, and so we'd rather put the money in our pocket than have you spend it on insurance."
Yeah, they like sellers. The sellers really like it though, because they get the cash immediately, right? And there's no escrow for them. So we see a lot of sellers who are increasingly motivated to use it. Hands up, are there a lot of private equity firms in the audience here? Okay, so I was going to say one thing that I like personally when we're running a process, especially when we can sometimes get 15, 20 private equity bids for a very hot asset on the tech and media side. call us before bids are due. Develop a relationship with the banker. It really makes a difference. If we call us many times. If we really like the person, and sometimes it's a private equity firm. I've never met the principal or the partner running that deal. Develop a relationship with me. It's actually at the end when we're picking people, I'll say, well, wow, this guy called us 4 times. He really wants the asset. They're really interested. Makes a real difference, particularly first round to second round. I've seen this a lot in the last year. So I think it's important, definitely make those calls if it's an asset that you want.
And to Adam's point earlier about management, to the extent as a private equity buyer, to the extent you can develop a relationship with management during your management presentation and really sell them on you as a good buyer, they may have some influence ultimately on who wins the auction. If they prefer you as a partner, they may be able to pressure the owners to sell to that particular buyer.
Yeah, and I think one of the ways you can go about doing that, and we see this, some of the firms that are very successful in moving through the auction process, and we have one who every deal that they've gone after at the end, in the past 2 years they've won, is they make that investment up front. They show that they're committed to the management team. They're bringing along industry experts. They're really bringing people to the table, so they have a team with them at the management presentation that understands the industry, has the contacts, and they're demonstrating from that very first meeting that they're taking this seriously. They've done their homework. They've maybe even done a first cut of some of the financial diligence based on the information that they have, but they're bringing the right people to the table and showing that they have the resources, the expertise, and the willingness to get the deal done. So showing that commitment up front, particularly from a sponsor's perspective, is really helpful in really developing that relationship with the management team and getting the transaction moving forward.
Yeah, I was suggesting develop a relationship with the banker, but agree with all that. I think developing a relationship with the banker, but also telling the banker, these are all the deals we've done in this area. So again, it gets the banker more comfortable. We were selling an asset earlier this year. I kid you not, we had 15 private equity firms who all bid 180 to 200 million or in that area. And we kind of looked at the bids and we said, okay, now what? How do we choose who to take into the second round? And honestly, it came down to those private equity firms who called us more between, when we put out teaser, between the time they got the information and they called us up for that first round bid. Those calls that they made to us, telling us about the investments they've made, the fact that they took the time to make those calls really made a difference in the firms that we picked to move on to the second round. And ultimately, it was a private equity buyer. So I think it really makes a difference.
Yeah, it used to be the days when the company that was selling could decide who they sold to, but now it's the bankers who make the decision.
Well, when it's middle market private equity firms, oftentimes, especially with founder-owned companies, they really look to the banker to say, okay, everybody's bidding the same. Who do we move to the next round? So I think, if it's a private equity seller, then I think it's different. Yeah. But when you founder-owned sellers, they definitely rely heavily on the banker.
That's exactly why it's critical for particularly the owner-operator businesses to make sure they're hiring the right advisors, the bankers, the lawyers, everyone who's involved in the process, because in most cases, a lot of the clients we work with on the corporate side, this is their first deal. They haven't been through this process before, and they need the right expertise to help them get through the deal in the right fashion.
Well, and I'd say I think there's 2 other things that are pretty important. As Mark had mentioned, a lot of sponsors are asking sellers to roll over pieces of their equity going forward, and so we see a way to differentiate just showing how we help grow the business and add value post-closing. I think the days of just buying something cheap and trying to get multiple accretion are gone, and it's really what can you do with the asset, how much value do you add, either operationally or through strategic insight. So I think that's something that you see a lot of firms. The day of the operating partner is really sort of on its rise, and that's something that we really sell to people when we talk with them, because we've got a really strong in-house team that can help add value, we think. But I'd say the second thing is also have people do homework on you. There's a lot of banks out there now that will actually track how people downbid from IOI to LOI, from LOI to close. Unfortunately, I know some of our brethren have a policy where their mandate is to downbid a certain percentage between each of those rounds. And so understanding who those folks are and trying to weed them out so that you don't waste precious management visit time on them, I think is pretty important. And the other is just make sure you do reference calls. I think a lot of people wait really late in the process to do the reference calls. The process we just went through, we were really thankful that they did reference calls very early in the process. And it was really interesting. They actually took a pretty creative approach. They said, we don't want you to pick the references. We want to take a look at your portfolio, and we want to pick the references. And they specifically picked a couple businesses that were doing well, but they also picked some businesses that didn't do so well and some that had bumps in the road. And being able to talk with those management teams and how we conducted ourselves and how we worked with them to try to get them back on track, that was something that at the end of the day, the sellers and the CEO of that business still say that was the reason why they chose us to move forward with us.
So Adam, this point that you just made about downbidding between the IOI and the LOI and the LOI in a deal, what steps can a seller take to protect itself against the winner either backing out or reducing its price? Is there anything they can do?
Again, I think do your homework in advance, and there are protections, but in the middle market and lower middle market, it's really tough to get some of the protections that you get on larger deals. But I would say it's really just doing your homework on who you're dealing with and understanding their track record. Call other people that have done transactions with them, see what they are like to deal with, see how they deal with the management team, whether management teams liked working with them, and just see again, do they downbid? I mean, everybody should downbid if they find something that's bad information, right, or the company falters and isn't performing as well. I mean, that should be expected. But I think the real trick is weeding out the folks that do it just because because they know they've got leverage once you sign up under the letter of intent.
Mark, have you seen any techniques that a seller can use in that?
Yeah, context? I mean, we certainly track. First of all, we only run, call it 6 to 10 sell sides a year at our firm. We're very selective in the sell sides we take on. We're not a firm that just churns out sell side after sell side. So I think for us, we're very careful. We do track the information, and we sit down. We've got 17 partners. We all sit down on a Monday morning meeting, and we say, on any deal, these are all the bids we have. What do you think? And we share stories. I think that's helpful in terms of understanding how people think about bids. But anything can happen, right? Anything in a process can happen. I would say if it's a founder-owned company and the founders are rolling 30% of the equity and are really crucial to the deal, it would kill the deal if the founders were no longer incentivized. I think, again, if somebody were to downbid, that's certainly not something that we would see a private equity firm do just for the sake of downbidding. I don't think they want to, impact or hurt the relationship they will have with this founder-owned management team. But certainly we have seen it in processes. It does happen, so I think you need to be careful and do your homework exactly.
John, have you seen any kind of legal techniques, drafting techniques?
I think it's tough to do that. I mean, I think it's really what these guys talked about. We do see people try to shorten the exclusivity period as short as possible, or to set certain benchmarks or hurdles that bidders need to meet in order to maintain their exclusivity, delivering a QOV within a certain number of days, or binding financing commitments within a certain number of days, reaffirming price, things like that in order to maintain their exclusivity. But I don't think it's a perfect...
Or don't give exclusivity, I was going to say.
That's right. That's
the
best
number one
result,
way.
right?
But I think the other thing you can do is before second round bids is really spend a lot of time, and we do this because, again, we don't do that many sell sides. We spend a lot of time with those bidders who are going to bid in the second round, so we know how much work they've done. Whether even anybody can say we've started our buy side QV, anybody can deliver a fully marked contract, but we have a real sense as to how much work they've really done, and that weighs heavily on us to say, their bid is real, or they may pull back on their bid because they haven't done as much work. So if you are a very serious buyer, you're very committed with your price, do a lot of work. I think that will demonstrate that you have real credibility in your price and that you're not going to pull back, even whether you have exclusivity or not, frankly.
What kind of steps can a seller take? Well, let's put aside the crown jewel type of property that everybody's going to want to bid on, one that maybe had a little more hair on it. What kind of steps can a seller take to attract prospective buyers to an auction of a company like that? Mark, do you want to start with that one?
Yeah, I was just going to say, hire the right banker. I think, look, again, we don't, and I don't want this to be a commercial for our firm, but because we take on such few sell sides, we really don't just take the same sim from the last deal and remake it for the next company. I mean, every process is incredibly tailored. We take a lot of time preparing materials. First of all, it has our name on it, but also we care about the process, we care about the company, and we want to make sure every deal that we do gets done. So because of that, it's a very tailored process, and having the right materials, the right story. Oftentimes it's surprising to me how you spend so much time on the marketing materials, you spend so much time with the management team, but then the bankers who are actually making those initial calls don't understand the story or don't fully appreciate the story because they haven't been so they haven't been hands-on. So our firm, we've a lot of senior people and a lot of junior people, no one in the middle. But we've seen this with other banks where you've got the middle team who's putting together the market materials, and even frankly, the senior people might be involved in that. But then when it comes to actually making the calls, it's the middle team that's making the call, who doesn't fully understand the story. And I think that really hurts. Those first calls, the first things that are said, how it's positioned, can really impact the interest in a transaction. Especially, so if you're selling hardware companies aren't that sexy right now. So if you're selling a hardware business and you call up a private equity firm, you say, we're selling a hardware business, immediately 85% of those tech and media private equity firms just pass. But if you can position that hardware company as, hey, it's a full solution, they have strategic partnerships with software companies, so it's actually not a hardware company, immediately you've reduced that 85% elimination down to 50. So I think it's really important that the right story is told right from the get-go.
Jeremy, we've used...
Actually, the one thing I'll add to that, though, is I think people need to be a little careful because it can be a double-edged sword. We see a lot of bankers that try to put a lot of lipstick on their businesses. To be perfectly frank, there was a business that we recently looked at where they kept saying it's a point-of-purchase display company, and I kept looking at the book and saying this is a furniture manufacturer, and lo and behold, we got out to the management presentation, and it was a glorified furniture manufacturer, and unfortunately at that point they had narrowed the group down to a much smaller group, and there were a lot of people that faded away from the process as a result of the fact that I think the banker oversold and was maybe a little too careful with what their story was. I think trying to be really honest with the folks that you're talking with is really important, and it'll help eliminate some of the surprises that you'll get later on in the process and really attract the right bidders.
Jeremy, have you seen cases perhaps where a seller will hire an accounting firm, an independent accounting firm, and provide quality of earnings reports to the group of buyers so the buyers don't have to go out and hire their own bank?
Never heard of it.
Really?
No, we do that. I mean, it's funny. If you look at 3 years ago, that was maybe 25% of what we do. And the other 75% was on the buy side. That's completely reversed, given where the market is now. So we spend probably on our transaction practice 75% of our time working with sellers or potential sellers. In a lot of these cases, well before they've even gone down the path of hiring a banker. So, and it's not just the sell side quality of earnings piece that's important. I think the positioning of the company is very important, and that's the role that the bankers are going to play. But the preparation piece is the most important. I always tell my clients, if you're thinking about moving down the sale process, start 6 to 12 months beforehand. And we have the ability to go in and do what I'll call a transaction readiness assessment, which is really, part of that can be the sell side QV, but it's really looking at the business from a buyer's perspective. And every operator out there, every management team, if they're thinking about moving down the sale process, they need to think about their business from a buyer's perspective. If a buyer were to look at my business, where would they see red flags? Whether it's in finance, whether it's IT, whether it's general infrastructure, whether there are issues on the operational side, whether there are process issues, people issues, identifying what those issues are, fixing what you can before you get out into the market, doing the sell side QV, which is really, I mean, that has multiple uses. So yes, you're getting the financial data clean. You have a lot of these smaller private companies, middle market businesses that are, they're doing their accounting for income tax purposes. They're doing cash basis accounting. Buyers are going to want to see everything on a GAAP basis. So doing the conversion to the financials, understanding what the adjusted EBITDA is going to look like so you can really maximize your value. But having all the numbers really tied together and having something that is comprehensive that can go to the buyers.
Do buyers accept those?
The buyers do accept those, but they're still going to do their own diligence. But at the end of the day, what you're doing is you're providing a substantial amount of at least the finance, accounting, and some of the tax due diligence information to the buyers to start that work. You're giving them a first cut. But I think what's even more important than that data is the fact that the management team then becomes accustomed to the process, understands what the buyers are going to be asking for, allows them to pull together the information. I spent the first 11 years of my career on the investment banking side and doing a lot of sell-side work. And you know what? When I stepped in there and we started pulling together the information that we would need to get out to the market, that took a lot longer than it should have. to help that company prepare for getting out into the market. Today, when we're spending that time well before they've made the decision of who they're going to move forward with a banker or pull the trigger on the sale process, they're getting the data room set up, they're getting all the legal documentation. We had one client that was a nice sizable business, but it had been in the same family for 50 years. They've been dealing with the same suppliers, same customers, and did not have a single contract in place, because everything was a handshake agreement. I can tell you, any buyer who walks in and looks at that, that's going to be a huge issue. So getting things like that fixed beforehand, in addition to the sell-side QV, it's really about the preparation.
I think our time is up. Thank you very much. Appreciate you guys helping out here, and we're all done.